Good afternoon, everybody. This is Gary Fullett from LTG Trading, a registered commodity firm, and I'm a registered broker with NFA, National Future Association. But first, before we begin, we like to have our disclaimer, which is on top, but as well as I will say it verbally. There's substantial risk and loss in trading commodity future options. Past performance is not indicative of future results. The opinions of those of Gary Fullett, LTG Trading, and are not recommended to buy or sell commodity future options for educational purposes based upon the teachings of Richard D. Wyckoff, which I subscribe to. So I have a very important chart that happened in the bond market today, and I put this in the newsletter, my daily newsletter that I produce. If you'd like a free 2-week newsletter, you can contact me at the above email address, and I will give you 2 free weeks of the newsletter in 1 hour of free recorded mentoring. And there's no obligation for anything. You get that free with no obligation, no questions asked. If you go to my site, www.ltg-trading, we have free webinars and other things. We do commodity brokerage, and we also have stock webinars, free stock webinars on Wednesdays for people as well, too. So please join us. Okay, so this is the bond market, and we can see that the bond market has been going higher. And I think one of the reasons why this has been happening is because the weakness in stocks provided bonds to go up. And we noticed that there's been talk about recent weakness in the economy, so higher bond prices mean lower interest rates. It's a reciprocal effect to that matter. So I think that has to do with it, with a little bit with the news and the uncertainty that people went and bought bonds. But nevertheless, Wyckoff is technical. So let's discuss and let's go further with the newsletter. And I can send today's newsletter if you like it to show you this actual chart. So we see the bond market that has been going higher. And we'd like to have some type of idea of maybe where the resistance will come into the market. So today, when I sent out the newsletter this morning, I looked at the reactionary high here. And I drew a line across the reactionary high here. And I connected these two lines. I drew a parallel channel down line, and this is my parallel channel, which is an important aspect of Wyckoff's teaching. I then looked at the market, and I wanted to see what the previous high was of the market, because the market was rallying. I took the reactionary high, which was right here, on August 27th, 2018, and that was at 145.29. And I drew a line across that line. Well, it came right to this point. I call this a axis point of the market. Where the horizontal retest resistance meets with what we call a reverse trend line, which is simply an overbought line in this case, where the market may encounter some resistance. So by connecting the previous highs, it gives us a objective point of the market. Again, I point this out in the newsletter, and the market broke. Very difficult to sell a market that has been trending up the way this market has been trending up, but it was a point of reference of the market in where the actual previous high was. So it's a logical point that the market may stop potentially at this point. It may have some type of correction. It doesn't have to, but it's a logical place from a technical standpoint to the market. An extremely, extremely important aspect of Wyckoff. This reverse trend line here is an overbought line. Does not mean a sell signal or a sell, just that it's overbought to Wyckoff, and an area that the market may pull back from, as I mentioned. This is the parallel channel that goes with it. These are not necessarily support and resistance areas. It just gives you ease of movement to the market. So let's see if we could have picked out a trade with a low risk edge to the market. So we have to go to a smaller time frame because this day chart gets painted or priced at the end of the day. So I like to use the 15-minute charts intraday to the market. And let's go to a 15-minute chart of that action and to see if we can make any heads or tails of where we could have placed a particular trade for potential, a good risk to reward potential. Extreme risk in the markets, and 90% of people lose money in trading, but we look for the edges in the market that may give us a situation where the market may give us a potential trade. So if you look at the market here, and let's put in our volume, which is very important, the Wyckoff price and volume, and we see that the market now has a reactionary high, another reactionary high, and we want to draw this line across here. The market then pulls back, and we want to be able to look at the markets and to see what the ease of movement of the market is. Well, this was that 146 level, or that 145.29 level that we found out in our daily chart. So we're using time frames to look for potential trade. This is a strong bar. This is a bar that encounters some selling to the markets. The week close tells us that selling indeed happened, or at least enough selling to make the market bar to go lower. If we expand this out a little bit to see the behavior of the market, we will then see the subsequent mark to go higher was a smaller range bar to the market. This is less volume, this bar, indicating that the market is not as strong as this bar. But the trend is still up, and we don't have a potential trade. In Wyckoff, we look at bars that have good volume and good price range. We find that right here in this bar right here. The volume is increasing, and we want to draw a line that goes across from here. We also have a selling bar. We also have a selling bar that occurs right here. The volume increased, indicating pressure on the market. The low way close sells that selling one from this last bar here, but we do not see a reaction from potential support. Since this market has shown selling in these two areas, we now have a situation. We have selling, and we have selling. We then look for the retest for a potential edge and a potential trade. The market then tries to go up. It takes 1, 2, 3, 4, 5 bars to retrace one bar here. This is what we call, in Wyckoff terminology, an up thrust of the market. Up thrust meaning a penetration of a high and a close back under this. So it took 5 bars to advance and 1 bar to go down. There's more pressure on the downside, in Wyckoff terms, and then the buying. It took longer to go up to go down. This is where we look for a potential edge to make a potential trade. Is at this 145.16 close, which is this close right here, and we would put our stop above this high of 145.19. Let's put the stop. This is just for educational purposes at 125. My apologies. Let's put the stop at 145.26, just to give it a little room away from this area. Again, this is a hypothetical setup. There's no trade that was taken here, but I wanted to show you the schematics if there was one potentially. So we could start at 116, which is 10 ticks. Bond ticks are 31.25 per tick times 10. The risk on the stop would be $312.50. If you wanted to make that stop a little bit closer and put it above 19, maybe put it 21.22 to see if you have a little bit of risk, that's okay too, because this market should not make a new high. I did here just to show 10 points. The market then immediately reacts lower, which is what you'd like to see. The market stopping actually go lower, and the market this begins to go down. So this is a great use of integrating time frames from a daily chart resistance, and you would have to wait for the market. The more conservative trade is to wait for the market to show selling and then sell the edge potentially of the retest of the upthrust of a selling bar. That would be a Wyckoff schematic trade, that one of which would be a good risk to reward trade. You probably would stay into the trade and put a stop, maybe above the previous high, or you could liquidate on the close and not have the risk at all at night. There's always risk of things at night. There's always risk during the day, but we always consider risk more than we consider profit. We consider both, but risk is the ultimate. So I want to thank you very much for listening to this YouTube webinar. It was just a short schematic of the bond action today. I did show this in today's newsletter that I had this morning. If you'd like a copy of that and a 2-week free trial, please feel free to contact the site or myself and be happy to send it out to you. Everybody have a great, safe evening. And if I don't do another YouTube video beforehand, have a Merry Christmas and a Happy Holiday and a very good, healthy New Year. Thank you so much for listening and hope to see you soon.